Okay, well, good morning, good afternoon, or good evening, depending on your perspective on the world, and welcome to Trading Coaches Playbook. This is Brandon Waddell with you, and glad to be here. Go ahead and kick this off. Oops, hang on, just checking something here. Okay. Anyway, so welcome everybody. Let me go ahead and make sure my chat is on so I can see you. There we go. Welcome Brenda, welcome Kevin, and of course everyone here. Yeah, so before we get started, just to remind everybody, we are not registered broker dealers or investment advisors. We're going to look at this information from an educational standpoint only, not telling you to buy, sell, or hold any particular securities or giving any personalized recommendations. There's always risk involved in the markets. Excuse me, we can't eliminate risk. We just try to manage it. And we're not subject to trading restrictions, so we get a position in a security to initiate one at any time. As far as what we do here, if you're not familiar with us at Wealth Builders HQ, we got a lot of workshops going on all the time. We got some of the free online ones. You can catch the Power Hour on Mondays. This Monday is canceled, though. I got an email about that. However, every Friday, we run a new Trading Coaches Playbook with myself and many others to show you some great opportunities in the markets. And there's a few other ones coming up. Myself, I've been running a program called the E-mini Think Tank for quite some time. And in the E-mini Think Tank, we run that Monday, Wednesday, and Thursday from 9 a.m. to 11 a.m. And we look at the markets live. So it gives you a chance to jump in and see what it is I'm looking at for trading opportunities and kind of follow along with me. If you are brand new to futures trading, there's actually another program that I run called the, oops, that's not what I wanted, called the Futures Boot Camp. So there's also that as an opportunity. If you're interested, you can join in on the Futures Boot Camp to actually learn how to trade futures. And the link is up there for that as well in the chat. Yeah, I think I saw an email that it might be canceled. I don't know. We got to check. I think it's just Monday. But I got to check that email again. I don't want to give you bad information. So actually, move my email out of the way here and see where, because I saw something. Yep. This coming Monday, Rob's going to be away, so he's not going to do Power Hour on Monday, but he'll be there for the rest of the week. It's just Monday. That's all. But anyway, so that's the boot camp. But like I was saying, E-mini Think Tank, we meet on a regular basis. In addition to the live sessions on E-mini Think Tank, we actually also cover, there's a on-demand recorded education that really teaches you the methodology that I use in order to be able to trade. So also, if you want to hang out with me in New York coming up, there's a chance for you to do that. I'm going to be doing a live event on October 27th in Long Island. If you happen to be in the area, take a trip out to the island and spend a day with me. It's called A Day in the Life of a Trader. And thank you, Miguel. Miguel's busy with all the links there. But basically, you're going to be able to hang out with me for a full day from 8:30 in the morning to 4:30 in the afternoon. I'm going to be sharing a lot of information about the markets and what I do for trading and how I do it, all that good stuff. So anyway, that's a little bit of the advertisements there. We're going to get in the meat of what I want to talk about today. You can also stay in touch with us, obviously, through lots of social media. I also have at Trader BDub for my Twitter handle if you want. And be careful, there's some people copying me and pretending to be me, but there's only one me, fortunately. So anyway, there it is. Yeah, I was talking about the spend a day with me live in New York. I got to find that suit. I have it somewhere upstairs. Maybe I'll break that out for the class. Anyway, what I'm here to talk about today is how to survive and thrive in a bear market. So let me go back over my charts. And actually, I'm going to save this because I was working on my spreads because I have spread trading that I do as well in futures. Something completely different. I want to get into that right now. But what I want to do is jump over into my normal charting here and just talk a little bit about these markets. Actually, I can also use this. Got Trading View open right here, kind of watching what's going on. I mentioned earlier in my Twitter that we should possibly expect some new lows today. However, doesn't look like it's happening right away. You could see that we've come down and retested prior lows, kind of bounced from that, and we went up, and I think we barely peaked above 60 right there. For those of you who have been watching me before, I use the RSI pretty heavily when it comes to momentum as well as trends and a lot of different things. So when I'm looking, first of all, to figure out what kind of market we are in, I go to higher timeframes. So I'll start off with the S&P. Let me clean up my chart here. And you can see that with this S&P, From the highs in January, we are currently sitting 23.5% to the downside. So once you go officially past 20%, you are supposedly in a bear market. So, I mean, no duh, right? We're making lower highs and lower lows. We knew we were below that, or in a bearish market way before we hit 20%. You can see right there, that's not even 20%. It's 19.95. It's close, but that's 20% that we pop back up. We're back down it again. And as you can see, we're making some fresh lows today. Or this week, excuse me, this week, not today yet, that is. But we have made some fresh lows. But one of the things that I notice is when it comes to the RSI, or relative strength index, or relative strength indicator, is that when you are in a bullish trend, and let's change this to a continuous contract. There we go. And this is now a weekly chart of the S&P 500, weekly on a continuous basis. And basically, when you're in a bullish trend, you can see right here, for instance, June 2020 till December of 2021, you do not see the RSI go below 40. So in a bearish or bullish trend, RSI will not drop below 40. It just doesn't, because you're bullish. So remember, the way I look at this indicator is a momentum indicator. So what happens is when you're above 50, RSI measures the bullish momentum. And basically, when you're below 50, obviously it's measuring bearish momentum. There we go. So you got your bullish momentum and your bearish momentum, depending on where you are on that, which side of 50. And the extremes are 40 and 60 that I use. I do change them from the normal 70-30, because 70-30 doesn't really work for me. I've been doing this ever since I became a charter market technician back in 2008, actually a little before that, probably in 07 when I discovered this. So in a bearish trend, RSI will not rally above 60. If it does, the trend is not there anymore, pretty much. I usually keep the setting on 14. Yeah, that's a great question. You see when I go to my settings here, you see 14 is the length. Some people try to change it to 13. I do not go down to 7, no. And the reason why, if you go down there, it's too short. That's the number of candles that you're averaging. So you want to, with 14, we're doing 14 weeks. Does that mean anything in particular? No, but that's the normal number that we use, and it seems to be working quite well for me so far. The problem with speeding up any indicator is it will be more sensitive, but at the risk of more false alerts. So I found that keeping it at 14 periods is fine, works out well. So I don't mess with that. The only thing I mess with is the overbought is 60, oversold becomes 40. That's all. So, I mean, you can see right here, when do we officially enter the bear market? Well, according to my RSI indicator right there in March, we dipped below 40. So at least that tells me that the bull trend is over, right? Because once the RSI goes below 40, you're no longer in a bullish trend. Well, that's pretty useful, because if we are starting a bearish trend, the definition of a bearish trend is lower highs followed by lower lows. So right here, when we started to bounce and we put in that low where we ended up below 40, and it's kind of hot behind there. There you go. That tells me when this relief rally came in the beginning of 2022 in spring, that we were unlikely to go above previous highs and most likely to turn down from the little basing and started that selling pressure. And sure enough, that's exactly what we did. So it allowed us to identify what was likely to happen. The other signal was right here. Remember, in a bearish trend, RSI doesn't go above 60. So when we officially made a high, and that high was not officially made until you break that low on the following week. So we officially went into a bearish trend there, well, no, I'm sorry, not yet, actually. We made the lower high and we failed to get above 60. So that's what it looks like when you're getting ready to start a bearish trend. Now we have the possibility of a bearish trend beginning because on that week, we have put in a high and a lower high. We went below 40. So we've broken the uptrend altogether. We also broke the uptrend because we made a lower low back here too. If you're in an uptrend, you don't make lower lows. It's higher lows. So there's plenty of warning signs. Just be aware for the next one. And then we dropped. And right now, this week, we are making more lows. Notice the rallies were not getting above 60. I mean, you can go all the way back to the last big bear market. Let's do that. Okay. 2008, 2009. And again, you see 2005, bounce in 2006. We're not going below 40, are we? On the weekly chart of the futures. And you can do this on the indexes just as easily if I put in SPX, the index. So how do we know we're getting to change trend direction? Well, there's a lot of other subtle signals. One is something like this. If we're moving up and making new highs, we should be making new highs with more momentum, not less. Okay, we call that a negative divergence. That's something else that I talk about heavily in the E-mini think tank class. You know, we're always on top of these things, trying to look not just at intraday opportunities, but longer term, trying to figure out what's going on in the markets long term. So we do look at all different time frames and strategies here. Anyway, you move forward a little bit. We're still bullish. That was just a pullback. And here we are making another high. And yet again, we're making another divergence in a couple ways. One is just this little bit at the end right here. And you can see that we're pushing a bit down, but even from big peak back here to up here, prices are going up, the indicator's not. You can see the indicator's moving pretty much sideways. So we're losing momentum. And then finally, did it happen yet? Nope, we're still making another high. But again, and by the way, divergence alone doesn't tell you you're switching trend, right? Every single time we pulled back, we did pull back, by the way, after divergences. But, come on, there we go. Every time we pulled back, we stayed above 40. So we're still in the bullish trend. Right here, we're no longer above 40. Notice preceding that, we made a high, very similar to what we just did in 2022. We made a high where the where the RSI could not get above 60. So that's showing weakness in the trend if you can't get above 60. And then, of course, the death knell is right there where you go below 40. And now we're bearish, and we stayed bearish for quite some time. How do we know when we're coming out of the bottom? And that's going to be the big question coming out, because obviously we're in a nice bearish trend. I just showed you. We need to know what are going to be the signals to let us know when it's time to start buying again. When do we know when the market's going to bottom out? Well, for one, they often bottom out at areas of demand from higher time frames. So if you're not familiar with supply and demand, again, that's something I talk about. I should probably show you if I go into my wealth builders. There we go. I think I forgot to log in, I guess. Thought I had logged in, but I guess not. Now I'll just do it again. It's easy enough. Oops, I hate when it does that. So let me log out and log back in again. There we go. And what I want to bring you up to is when I go to members section right here for the E-mini think tank, there are pre-recorded educational videos that teach you all these things. And of course, we obviously practice it 3 days a week as well. But you can see right here when I go into my bonus videos, there are trading routine and finding zones and things like that. So there's lots of self-paced education designed to help you trade properly in the markets and even do things on trends right there. So if you're struggling with being able to find those things, I can help you out, obviously. Got that information there for you. So that being said, going back to the market, whoops, right here. One of the things that we should look for is weakness in the bearish momentum. Okay, so right here, prices are making new lows. RSI is suggesting that we are losing bearish momentum right there. Now, we're still in a downtrend because we're making lower highs and lower lows, although right here we had a peak just barely above. Now, we didn't get above 60, okay? But if we come down again, remember, if we're still bearish, we should easily go below 40. And as we go forward here, oops, doesn't show. There we go. You can see that we just put in a bottom right there. And when we put in that bottom, we did not go below 40. And that was a big flag saying, whoa, wait a minute, we've made a new high in price, just barely, but it was a new high. So we're no longer in a downtrend, right? Because we broke the definition of a downtrend, but we're also getting more bullish pressure, not enough bearish pressure to continue the trend. Technically, that's higher low and now higher high. And we're in the uptrend again. So we should be focused on the longs. And it keeps going. We had a little dip right here, a little fake out. Notice we broke to a new low right there and tried to rally. Sorry about that. Lucy's behind me going berserk about something. Sorry. Anyway, you can see that we did, where was I here? We did make a high right there and couldn't get above 60. Then we dropped below 40, but this was just a fake bearish move. What happened was on the next low, failed to make a new low, failed to get below 40. We're going back up again. And again, in 2011, we dropped. This time, this peak was just barely above 60. So it was kind of a shock to see that we actually did break down and make fresh lows. Well, we're below 40. And you can see we made a new low, still below 40. Can't get above 60 yet. We're still bearish. But there we put in a low, again, not below 40. That means this whole bearish move from 2011 is over. We're getting ready to move up to some new highs potentially. And there it went. So you really don't go below 40 very often. There again, 2015, another pullback, went below 40. But again, before we went below 40, you make a peak that's not above 60. We actually made two of them. When you think about it, right there is the other one. And when I'm saying peaks and bottoms, you got to also recognize that it's actually a minimum of 3 candles to give you that formation. Let me show you. And in order to call a peak or a bottom a bottom, it has to be a 3 candle formation at minimum. So for a top, you got to have a candle. And the shape and color doesn't really matter much. But you got to be having a high with higher highs on both sides, or sorry, lower highs on both sides and lower lows on both sides. So officially, this becomes a peak when you break the low of that candle, that center candle. That's when it's officially a high, and you can start using the measurements. Typically, you know, this will be red right here for that because we're going to be heading down. Now, the other two, doesn't matter color of the candles. Usually this will be green, but it doesn't have to be. It could be red. And the same thing when we get to the bottoms too. If we start looking at price moving down and making bottoms, it's officially a bottom being put in when you have higher low and higher high from that center candle. There we go. Come on, can't draw a straight line today. Well, it's close. There we go. But as soon as we break the high of that central candle, there we go. Right there. And again, for us to leave, usually it doesn't always have to be, but this will end up being a green candle. Evening and morning stars, technically no, it's got to be gapping in order for it to be a star. Evening and morning star, this would have to be gapping away above the high, and this would actually, this center candle would be gapping below. But yeah, there's patterns that you can look at as well. But just the very simple thing for highs and lows is that, you know, for the high, you've got to have a candle that makes a high, and on either side, you got lower highs and lower lows. Sometimes it takes more than one candle, by the way. for it to show the high or low, like right here. If I could do something like this, where I have high, we have this kind of candle. Oops. That doesn't have to be perfect. And then right here, we have something like this. Again, it doesn't really matter the wick on that one. There's your high. And on this candle, we couldn't make the new low right away, but the next candle we did. Okay, again, it becomes officially a peak as soon as the low is breached. And the same thing would happen if it were a bottom, right? So now we have, this is our high. We have had lower highs, and now we finally get the lower low after it. So that's what I'm looking for when it comes to these charts. And again, going through, how do we know we're bottoming out? Usually we'll get some sort of signal. You know, right here, we're trying to put in a bottom. As a matter of fact, it did right there, subtle. There's a bottom in price, and the RSI could not get below 40. Okay, you do see low, higher high on either side. That's it. And it still kept going down because we couldn't get above 60. So you can see that once we break to a new low, we're continuing to move down, still bearish. Now we're getting another divergence. Again, there's usually signs, either divergence or we'll get a low that fails to go below 40. On this one, this was no divergence, okay? Only this was divergence right here. That's just a move up. So we try to rally up, pulling back a little bit, and there is our low right there, where we are not below 40, and it's after the divergence. Now all we need to do is make a new high, and we're in an uptrend again. We did make the new high first, made another low, surprisingly enough, but not below 40, so we're still bullish. And there we go. So flash forward to where we are now. And we had all the signals before we went lower. As we kept rallying here, every single one of these peaks, people were saying, oh, you know, we're going to be okay this summer. Look at this. The markets are coming back. This is our rally. And, you know, myself and many other people were looking at this saying, no, wait a minute. No, we still have to make a low where we are not below 40, right? And you can see every single one of these lows on the weekly chart, every single one is below 40. Okay. And even this, that one's actually close. We got a low right there, higher low, higher high, but that was close. But on the rally, we failed to get above 60. So we can't get above 60. We can go below 40. We're still in a bearish trend. So a couple things we need to look for. Let me clean up this chart. Actually, no, I don't want to do too much to it. I want to go back there again. The question is, how do we know we're at the bottom? And how do we know we're out of this bearish trend or that's ending? Well, for one, we should look for things like divergence. Now, divergence alone usually only means a bounce. Okay, you can see we had divergence right there. Prices try to make fresh lows. The indicator was not doing the same thing, so we had that pretty good bear market rally, which led us back down again. I actually forgot to check to see if this was a trend line. Yes, it is. 1, 2, 3 touches, officially a trend line. Look at that. Extend to the right. There we go. Now we have our official bear trend line too. Uh-oh. And you can see it's a nice bear trend. It's getting stronger to the downside. 1, 2, 3, because that's widening a little bit. So I mean, I don't know if we're going to touch the bottom of that, but we could easily down here at 31.50, 31.25 if we continue this trajectory. But that's kind of what we're in right now. So how do we know when we're ending? Well, again, first sign would be one of two things. Either we're going to get a positive divergence and or we're going to get a low where RSI is not below 40. That would be the better one, the RSI not below 40 on a low. And obviously we're not doing it this week because we have gone below 40. And I think last week we even closed below 40. So definitely not happening this week. But we are seeing a little bit of divergence. Now it's not official because we haven't finished this move down. Although if we do finish off today, Friday, with that low the way it is, you can see prices have made a fresh low, but momentum has not. right there, we made a slightly higher low, even though we made lower low in price. Actually, it's not even so slight. So we are getting closer to the end of the downtrend, but we're not there yet. The other thing I mentioned is that typically when you turn, you're going to turn at areas of demand. If we go back in time here, we're not at a good demand zone yet. This is not a good demand zone. As a matter of fact, looking back for demand, it might be here under 3,000. We got, that doesn't even quite qualify for me. I'm looking for an area, a specific pattern, and really it's almost this 2,600 area. I don't know if we're going to get that bad, to be honest with you, but it could. You got to drop, base, and then the rally up. That's the origin of the move back in 2020 that we can retest. It may use something in here as well, right around that 3,000 level. And the reason why I say that, let's see, I don't think all these candles closed inside of the leg in. That's why it doesn't fit for me. I've got specific definitions that I typically use for the zones. And that red candle closes a little too low. Otherwise, I would have been able to use this area. And even there's not a strong rally up. Plus, might have been tested already. This one also doesn't quite qualify either. So that is my nearest demand zone on the weekly chart. Now, when we go back in time to the 2008 crash, right here, you had to go back, and it's not going to show it on the futures because they didn't exist beyond 1998. But if I go to the index, let's see, S&P 500 index, there we go. Now we'll be able to go back. Okay, so first of all, looking at our current price, let me clean up my chart here anyway. This is the index, which is what the futures are based on. It's not working. There we go, horizontal line. And pretty much on the index, same thing. The first really strong demand zone is down here. That closes too low, and there's not strong movement out of there. So this is suspect and really could push us down into 2,500. Wow. Anyway, what I also wanted to get to was right here, just show you that the low in 2008 took us all the way down to this fresh level from 1996. Basically, right in here. Is where we went. Looks a little better. I think it was the monthly, maybe. And I mean, if you included all this basing right here, it pretty much encompasses rally, the base, and then the start of the overall rally. You can see how sideways we were in 1996. Then the overall bullish move that came out of that ended up being the bottom of the markets in 2008, right there. And the overall drop for the bear market, come on, there it is 57%. So if we go to our current drop that we're in right now, let's see, what would our measurement be for that percentage? Are we really that far off? Get rid of that extension. Actually, could have done it this way. There we go. Go to the high. And if we duplicate 50% or so, that puts us right in the target. Look at that. That's 50%. So it's not really out of the realm of possibilities to see our bear market and say that, hey, we're only halfway done. And this is a long bear market so far. Well, not really, actually. We're only 6 months into usually what's 18 months, right? So if we're only 6 months into what's something that's normally 18 months, we're only a third of the way into, I guess we're more than that. Sorry, we're 10 months in. 10 months in. We still have another 8 months. That makes sense. We're only about halfway in our bear market right now. So what I'm going to be looking for, obviously, is on this big picture weekly chart, those signs of bullishness. Now, what do we do in a bear market? Well, first of all, if you're a stock trader, you got to be really, really careful, because what a lot of people do is the wrong thing. A lot of people think that they should be diversified in a bear market, thinking that, okay, I'm just going to buy a lot of stocks in different sectors and I'll be fine. Well, that's definitely the wrong thing to do. Okay. When you take a look at the sectors here, this is the sector performance chart, and we'll just go back the last 6 months. Okay. And this is how these markets are performing against the S&P 500. Now, most people look at something called the sector rotation model, which is shown right here. This is on stockcharts.com. Okay, it's free, you can get it, it's no big deal. But what normally happens is the stock market, which is in orange, goes through cycles. You have market bottom, bull market, market top, and then bear market. Okay, we're in a bear market right now. So you look above where we are, and those are the sectors that should be outperforming the other sectors. That does not mean those are sectors you should be buying. And that's a mistake a lot of people make. They think, oh, I'll just buy consumer staples because they're supposed to be performing well in the beginning of a bear market. No, they're outperforming other sectors. By the way, you'll notice that the orange, the stock market, leads the economy. Okay, now we're actually in early recession right now. We're starting that recession because if you take a look at the GDP numbers, we have had a second quarter of negative GDP growth. Okay, that's the official signal of a recession. And I believe that just happened. If you go out to Forex Factory and you look at, I think it was Tuesday. Which one was it? No, it was yesterday. Yesterday, you see there's the final GDP number quarter over quarter, and it's a negative number. And you look at the previous number from June for the first quarter of the year. This is for second quarter this year. And the first quarter was negative 1.6. Second quarter was negative 0.6. That's 2 quarters of negative GDP growth, which is a recession officially. So there you go. We're in it. But the stock market turns first. So let me get back to the sector rotation that people screw up, because you look and you're thinking, wait a minute, Brandon, if I had bought energy, staples, healthcare, and utilities, I would have made money. Look at, they're all positive. No, that is how they are performing versus the stock market. Let's take out the stock market. That's how they're actually performing. Okay, big difference, isn't there? So what we need to do is not just be defensive by shifting into defensive securities, but we need to defend ourselves. And maybe if we want to profit, find securities that profit in downward moves. So if you're a stock trader, well, we have things like ETFs and inverse ETFs that you can get into. So if you start looking for inverse ETFs, let's take a look. We can go to etfdb.com. Now, if you have a 401k, there's really not a whole lot of things you can do. Unfortunately, the best thing you could possibly do in a bear market with a 401k is go to cash. Now, I'm not saying pull money out of your market, your 401k, because that, again, you unfortunately will have taxes and fees. But what you can do is shift your money from an active mutual fund into a money market fund. Money market's like holding cash. At least you're not going to be losing money. You're losing in inflation a little bit, but you're not going to be losing actual dollars with the market going down. So you got to be a little bit defensive, but you also have to be careful because some people can only adjust once a quarter. So you got to make sure that you identify the turning points in the markets and the charts and know when to make those adjustments. Because if you make them too late, miss out, and you miss the bottom, you could have made money back. Or if you get in too early, again, you can miss out on opportunity. So right here, we have an ETF screener. Oh, they changed the name, Vetify. It used to be ETF database, still the same email, same page, etfdb.com. But right here, I can go in and take a look at, let's see, attributes, or what do we have here? Equities. So we want to look at the stock market, and we can look at things, doesn't really matter, whatever cap we want. But when we go into, let's close this up. For asset class, attributes, I think that's the one I want. Inverse, there it is, yes. And the screen should be about 75 now that are inverse. Now, here's something very important to pay attention to. Leveraged ETFs. Be careful, okay? Leveraged ETFs seem great. Right here, for instance, SOX, SOXS. Direxion Semiconductor bear 3 times shares. Ooh, that moves opposite of the semiconductor index 3 times. You're probably thinking, I can make 3 times the money. Yes and no. The problem is that it's rebalanced every single day. And because it's rebalanced every day, if let's just say that let me put it this way. Let me zoom out. It'd be easier to do it on paint, I think. Let's say you got the market, and then you got your leveraged ETF. Okay. So right now, that market, well, let's say the leverage ETF, is trading at $100, okay, per share. Let's say the market goes up 1%, okay, and let's say this is a 2 times leverage ETF, okay, just 2 times. Make it easy on me for the math. That means that ETF has now grown to $102. It moved up by 2%. However, the next day, let's say the market goes down by 1%. Actually, it should be the other way, right? It's supposed to be inverse leverage, but it doesn't matter. You get the idea. Now, that is going to move down 2%, but not from $100, but from $102, right? So 2% of $102 it's going to drop by 204, which now means your ETF has dropped below your entry price. Now, it doesn't seem like a lot, but when you start adding up a lot of shares, it can really hurt you. Going up and down by a percentage, let's say it goes back up by 1%. Are you back to break even? Or are you even back to the gain you had originally? No, but here in the market, it's gone up, down, up. The market's actually up 1% from where it started at this venture, but you're not back to the 102 gain. You're going to be much less. You're only going to gain 2% of 99.96. So that's what you got to be careful of with these leverage ETFs. And when we start going 3 times, it gets even worse. So because they're taking that new cost basis every single day rather than readjusting after a month or so, these are not designed for investing. Okay, they're designed for trading, intraday trading. That's fine. So we want to get rid of those leverage ones. We could just go 1 time. And therefore, these would be better for you to possibly do things to help protect yourself. If you can't do things with your 401k, perhaps you can create your own personal IRA, which could have very similar tax benefits. By the way, I'm not a tax professional, so I can't speak to that, okay? But you can do things like hedge your portfolio by buying this in an alternative investment program. That way, when you lose in your 401k, at least you're making the cash up somewhere else in a different retirement program. You could buy things like the Pro Shares Short Russell, RWM. Okay, so when the market drops, RWM should be going to the upside. Or instead of the S&P, when the S&P drops, you got SH, which is the Pro Shares Short S&P. So you can see in 2022, that's been going up. And it should be going up inverse whatever the markets are doing. So you go from the bottom of this to the top right now, and that is up 26%. Meanwhile, we saw that the S&P is down about 27%. So if you had this as a hedge, you're basically 1-to-1. You just got to make sure you properly weigh out your portfolio. And that's a little more than I want to get into. Well, I can mention something called beta weighting. In order to do this properly, you have to figure out what the beta weighting is for your portfolio. Okay, I haven't done this in a while. As a matter of fact, if you do it with, if you have an account at Thinkorswim, there's actually a button you can push that automatically beta weights your portfolio, but I'm not going to get into all that right now. Beta weighting is simply figuring out what your beta is. A beta is how much your security moves versus the S&P 500. So let me see if I can find a typical mutual fund. Where are they here? Finance home markets, top mutual funds. There we go. I don't know what any of these are. I'll just click on one. But basically what you can see is when we go into this, oh, that one doesn't show, of course. Doesn't show beta on that one that I picked. Domestic Opportunities Fund, also one that doesn't show. It must be too new. Figures the high flyers. All right. I can't seem to get the beta on any of these. I mean, if I dug deep enough, I just don't want to spend too much time looking for it. Boya corporate leaders. Anyway, what I'm looking for is right here. It says beta, but some of these securities are somewhat new, I guess, so I can't get the betas on them. That's all. But you can figure out the betas and how much of a weighting it has in your portfolio. And they should show for some of these. Let me see. Beta, why is nothing showing? I'm just trying to click on any of these. It's weird. Oh, well, I might, like I said, I might just be on the wrong site for it. But typically you can find the beta, weigh out your beta, because if a beta of 1 basically moves the same as the market, a beta of 1.5 is 50% more volatile. You might need more of that ETF to completely hedge, because a hedge is when you lose and you gain just as much as you lose. So you got to make sure it's evenly weighted for that. Now, there are some other things we can look at. Typically, when the markets drop, there are rotations for assets. And if I go back to, took it off, stockcharts.com, under performance charts, which one is it here? Now I'm going to remember. There it is, Intermarket Study by John Murphy. John Murphy is pretty well known in the technical analysis industry. He was actually one of the first chartists for CNBC, back when it was FNN, believe it or not, Financial News Network. But you can see right here, he talks a little bit about these rotations, not as much. He actually recommends their book. It's not a bad book, actually. I really enjoy it. But it talks about the relationships. So between stocks, and let's see, what's going to be moving with stocks? Well, we don't want to buy commodities because, as you can see, stocks and commodities have a positive relationship. Okay, well, the dollar moves opposite commodities. So there might be some investment in the US dollar then, because that could go up. And there's an inverse relationship between commodities and bonds. Therefore, there's an inverse relationship between bonds and stocks. So there may be opportunities in US dollar and also in bonds. Traditionally, those are sectors or assets, if you will, that tend to rally when the stock market drops. It's not perfect, okay? You got to understand there are these normal relationships, but then we also break off from the norm from time to time. You can see when we were very inflationary this year, the commodities were going up in blue, okay? The stock market was dropping. But wait a minute, we just read down here, there's a positive relationship between stocks and commodities. Yes, there is, but only during certain cycles. Each one of these securities moves in cycles that are actually offset from each other. So, you kidding me? My dogs are wrestling behind me now. For instance, here you get a cycle like this, up and down. If I can get a good cosine there we go, kind of. Okay, so that's one. But nope, that's not what I wanted. Copied the wrong thing. So I'll just draw another one. That might be the stock market cycle. And then you'll look at, whoops, wrong one. Here we go. This could be bonds. Well, let me drop it enough. Anyway, you can see they do move together sometimes, they move opposite sometimes. And then commodities be the third, as we were talking about it. And that's going to also be further offset. What happened there? So the way they are when it comes to these cycles, all of them are offset. This can also, when you know the cycle of these securities, I didn't quite put it in the right area there, but you get the idea. What happens is if you know where we are in these cycles, you can actually predict when recessions are going to be hitting as well, because there's a lead time for each one of these before a recession hits. And I forget exactly what the leads were. I used to know them. I just don't anymore. I apologize. But overall, if we start now taking a look, whoops, wrong one. Start taking a look at things like treasuries. There we go. This is the price of treasuries. And actually, again, we've been inflationary. So for 2022, this is not a normal thing. You'd want to see people buying bonds when the markets are dropping, right? Well, instead, there was a little bit of buying here at the beginning of February, but for the most part, the markets are dropping. Why? Well, they're dropping because the Fed is trying to raise rates. And as I was saying, the movements are offset. Okay, they're not going to be in complete sync. And also, let me see if I can find it right now. There we go. MRCI does a really good job with this. This is a free web page you can go to if you just type this in. If not, you got to actually log into MRCI and pay, which I actually have a subscription to anyway, but that page will get you to this. Right here, I can see by looking at, say, for instance, the S&P 500 going across, it'll tell me what the relationships are between bonds. Right now, they're moving together 75 and 72% of the time. 75% of the time, we're moving with the 30-year bond, 72% with the 10-year. So that is not a hedge right now, is it? We need something that's moving opposite of it. And sure enough, the US dollar, let me zoom in more. Right now, the US dollar is moving opposite of the equity markets, 77% of the time against the Dow, 79% against the S&P, and 80% of the time against the NASDAQ. So Forex could be an opportunity for us, either US dollar futures, if you could trade those, or spot Forex markets. So if I take a look at DX futures, I'll probably have a delayed data for it, so I don't pay for the ICE data, but you can see right there, the US dollar has been steadily rallying as the markets themselves have been dropping. So that is one opportunity. You got to find what's moving opposite to hedge yourself. There's always a bull market somewhere. You just got to find it, right? And we can also look for things, as I mentioned, Forex, Euro US dollar. I'm actually putting together a new product I might be launching. It's not out yet, but so far, the products that I do for wealth builders, I mentioned the E-mini Think Tank. That's kind of my flagship program for futures trading, but I'm not just a futures trader. I actually do a lot of long-term investing in the Forex market as well. So I'm going to be hopefully introducing something very, very soon on the Forex market. So if you're a Forex trader, look forward to that. Just kind of keep an eye out to see when that's coming out. But you can see that we could have been shorting the euro versus the US dollar because of the strength of the US dollar. And we're still moving down. We're making fresh lows. Our highs are nowhere near 40, let alone 60. This does not look like it's going to end soon. And it's a great time to travel across the pond, if you will, right? Even looking at the pound, it's been doing this. So we're actually seeing that the US dollar is stronger in value than the euro. It's the first time since the euro was created, basically. Going all the way back in here 2002, and we don't have any demand, by the way. Maybe we have a little bit of weekly demand right there that we're almost at. Other than that, forget it. So take a look at the pound. And we're currently at almost $1.05 of this week. We dipped. We're at 111 right now. I mean, you have not seen that weak of a pound against the US dollar, I think, ever. You know, I can only go back here to 2002. So there you go. So we definitely want to look for more opportunities, and there are. There's plenty of supply zones to be able to short on the way down, and there's no sign of the strength that we need in order to be able to stop the decline right now. So we can also look at inverse things. I forgot to mention, if I go to, actually, I'll use continuous contracts. Wrong one. See if that works. And you know what? This is still moving in the same direction right now. The Japanese yen often is a hedge, but I should check to see what the correlation is right now. Nope, the Japanese yen's moving with the equity markets because the dollar is so opposite of it. Normally, the Japanese yen is a safe haven security. So when the stock market drops, you get the yen going up as well, but not working right now. And not really anything else is a good hedge right there. So what is the probable low for the NASDAQ is a question being asked. Well, if we take a look at the NQ, we can look at the index as well. It's probably easier because we're going to be going back here in time. Let me go to a monthly chart just for fun. And you can see we do have some lows. By the way, we're at a monthly demand. And on the monthly chart, we haven't gone below 40 yet. You can see it does not happen very easily. It did back in 2008. Sorry. Anyway, going to that weekly chart, let's go to the end and see what we've got for targets. And right now, the interesting thing about the NASDAQ, by the way, that's a great question to bring up. And one of the things I want to talk about before I start looking at this is what do we call my comparison chart here? If we take a look at this percentage change chart, I'm going to go to a weekly chart there as well. What we want to do is figure out who is leading us in which direction. And right now, from 2022, this big decline that we've been having, let's make sure it's the right spot. You can see the NASDAQ has been the weakest market from the highs. And that's been our leader to the downside. When the leader bottoms out and bounces, that's when the other markets are free to go. If not, they're going to get dragged to the downside. So the NASDAQ is really the clue here. So Brenda, that was a great thing to bring up. The NASDAQ, where's the bottom there? Because that's really the bottom of the market, not the S&P. So looking at the NASDAQ right now, one of the things that's kind of interesting is that we are trying to make new lows this week. I don't know if we're going to be able to do it. I thought we would, but you can see we're not getting the same momentum that we had before. We have less bearish momentum, and that's divergence. So we may be getting closer. You look back for demand, and it's pretty much the same picture. When it comes to the NASDAQ, I don't even know if this is good because that doesn't close below. You got that drop, base, 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 and then kind of a weak rally, honestly. So it could be close to 8,000. If that's the leg in candle for the drop-based rally, but it's not even that good. This is a little bit better. It's also a little bit higher, which is good. The bulls rally, base, base, and then there's your rally up. And because we have that, could just be this area right here. Right around 93.45 to 83.42. And you can see that we're actually coming down to an area as we speak, though it's not a very strong area and it has been tested. So I think if anything, we might get a pause there, but we're going to keep going down until we get to 9,300. So again, looking back at where we are currently sitting, and I can also look for some correlation between that and the size of the preceding impulses as well. And wouldn't you know, it projects right there too. So we're looking about 9,500 to 9,300 for the possible low in the NASDAQ using Fibonacci extensions. They can work pretty well. They're not the best when it comes to stocks, but you can see we bottomed out at the 100% previously, overshot it a little, and then came down again. So it's not unreasonable for us to do the other 100%, basically duplicating the previous moves down before we get a bounce there. So that's what I would say. And of course, as we get down there, if we start to see a positive divergence, number one, or number two, if we get a low where the RSI doesn't go below 40, that'll be your sign the market's getting ready to turn back up. That's when you start shifting into bullish mode. And those are things we'll be watching, obviously, in the markets long term. And I talk about those in the classes. So if we have any questions, I'll stick around for a minute or two to answer questions. Pretty much wrapping up here. Kind of showed you a little bit about what's going on in the markets, what to look for the bottoms. Again, we want to find things that are going to be performing well in those particular market directions, and be careful because there's a lot of myths out there of what people think is right. Diversification really means diversifying in asset classes, not just sectors of the markets. That doesn't work. When the market goes down, it all goes down. But what we can do is look for opportunities in other markets. We can even do things like, let's see if this one works right now. It's actually moving up right now, which is a bit unusual. The Aussie yen, that is really unusual, actually. I was thinking this was going to go down. The reason why the Aussie yen usually moves, it moves with the S&P 500 typically. I'm kind of shocked this is still moving to the upside because the Australian dollar is fueled by commodities and the Japanese yen is normally a safe haven, but it's actually moving the opposite direction right now. So this may also be continuing to the upside. You see, we can't make lows below 40, so there may be more opportunity on the Aussie. Can't imagine the Aussie dollar is doing as well. No, it's just against the yen. Interesting. Like I said, there's bullish opportunity. So there's others out there. You just got to look for them. Spreads are actually better. Oh, that's a great question. Linda's asking, are spreads still okay in wealth with spreads, or are they more difficult? No, they're actually better with the higher volatility. I was talking with a friend of mine the other day, John. I don't know if anyone knows John Rowland. I was just talking to him. He used to be one of the biggest spreaders of energy markets in the NYMEX on the old trading floor. And we were talking about that because he's doing some workshops on it too. And obviously I do wealth with spreads with another program that I run. And the spread program he said that the volatility is great for spreads that's coming up right now. And if I take a look right here, hang on, let me see, where is it? I finished off August. We still have trades open for September. If you're not familiar, I've done workshops on spreads. You can take a look at those. But when it comes to spreads, what you're doing is, I'll zoom in a little more so you can see this, you're basically buying and selling securities at the same time, basically like a Forex trade. You're trading one security against the other. So when you take a look, for instance, here, we've got the Canadian dollar versus the euro, or the 10-year bond versus the euro dollar, right? Or the 30-year versus the 5-year. And you just trade them against each other. So the nice thing about those is the margins are much less than if you simply held those securities outright overnight. And the other neat thing about this, I'll just go show you, the win ratio is usually higher. You know, if I take a look at, let's see, do I have open? There it is, E-mini Think Tank. Because I keep stats on all my programs that I teach, obviously. You know, these are all the trades from the month for E-mini Think Tank, and you can see it's not bad, but for the month, E-mini Think Tank profited on the trades. We had 17 winners, 9 losers, 51 no entries. They just never hit entry, but I was winning 65% of the time when I took a trade. Okay, and there's positive results for that. However, looking at the spreads, now we're at 75%. So it's typically higher. I have a much bigger win percentage. You can see 12 wins, 4 losers, only 3 no entries. Okay. There's still a bunch that are pending as well. As a matter of fact, I should show you August. If I go into open, August has been closed out for the month, wealth with spreads. We actually finished all those trades. And again, looking at the efficacy rate, there we go. We had 13 wins for the month, 4 losers, 5 no entries, and the win rate was 76%. So regularly, I'm much higher on the win rate with spreads than I am on any other type of trading, and the returns are better typically. You know, the rate of return is going to be a bit better because we're getting better trades. So yeah, I think spreads, I was just looking and working on the October spreads for this week right now. That's usually what I do. I put together the video on Friday, record it, send it out on Saturday. So with the wealth of spreads, it's actually getting better. I actually have 1, 2, 3, 4, 5, 6, 7, 8, 9 trades I'm putting out this week. And sometimes I'll put out a minimum of 4, but you know, I usually get about 5 or 6 trades minimum. This week I'm putting out 9 trade ideas because there's just so many good ideas out there, and I'm not done. I might even have a couple more. So yeah, I think spreads are a great opportunity. For one, they are good no matter what the market does. Doesn't matter if the markets are bullish or bearish, you can profit from spreads. You're simply trading the price relationship between 2 related securities. So, and yes, I text the students when it hits entry. What happens is with the Wealth with Spreads program, as we'll talk about that a little bit, the link was up. When I go back to that, it is a combination. It's a little bit different than the mini think tank, but what happens in Wealth with Spreads is you learn how to trade by watching a lot of the videos. It's kind of a self-paced, on-demand education here. In addition, we do what's called Mastering the Spread, which is a live session that I do every other month to answer any questions. Of course, at any time, you just send me a message and we'll answer your questions. It's not a big deal. But yeah, you learn how to trade the spreads if you don't already know, watching Spread Trading 1, 2, how to trade it on the different platforms. And then I put out those ideas every week. I put out a video, as I said. Additionally, with the video, I put out a PDF that you can download that's all my slides for the video with all the trade ideas. Then when the trades come into play, we actually send out an SMS text. So for instance, there was one that hit a small stop loss today, Australian dollar versus the Swissy. And then there was another one Australian dollar versus the euro that actually is winning so well that I had to move the stop down. So yes, there are real-time alerts going out when the trades are coming into play. That's, again, what I was working on right here. We go to September. Save that. Just show you what I'm tracking right now. These are the still pending September trades. As soon as it loads my screen. There we are. So for instance, we've got lean hogs versus live cattle. And unfortunately, this was a long opportunity that I missed. The entry actually triggered right here, but I missed it, and it's up very, very well because, well, there were certain circumstances I didn't really care for the entry. Let's see, it was one. This one's open right now. The one I just mentioned, Australian dollar versus euro, as a matter of fact, just hit target number 1. So I mentioned earlier today to move the stop down. The entry was way up here as we hit a supply zone. And there's target number 1 being hit right now. So I got to send out that text, as a matter of fact. So I'll go ahead and do that. Let me see. September tracking. And I have to do it manually. So I got right here. And let's see where we want to move our stop down to. Probably keep it pretty close to where it is, 7,600. But we're now hitting 5610 demand zone. And I could send out the text. Members, where's the questions? The Qs? What do you mean, where's the Qs? Trading spreads? On the NASDAQ? I don't do them. I do them mostly on futures. I have to log back out, log back in. So this is, it's called Wealth with Spreads. That's the service. And I actually manually send out the alerts. I usually get alerted. I forgot to see my alerts on my other page. And they come to my phone, so it tells me when the trades are hitting the zones. So for instance, right here, I go in, oops, wrong one, right there. Hopefully, I don't know if I caught the right one, hang on. And that was from 9/18. Let's hit target 1. Let's just say near. There we go. And right now we're near 5,600. And my trailing stop is currently at 7,600. There we go. So now I got to go on I got a couple other monitors on so I can actually put in my trades and close out my positions for that profit right now. So anyway, keeps me busy, that's for sure. But yeah, that one's hitting target number 1. Target number 2 is not too far away. That is now a little bit more profit because we got out around 57. Well, I'll call it 5,700. So it's about a $4,000 gain just on that one. And if you take a look at the rate of return, our margin for that trade was $3,400. So that's over 100% rate of return. There we go. So anyway, yeah, the spreads are doing really well. You just got the SMS. Yeah, it goes out pretty fast. I know I got it on my phone too. It fires them off pretty quick when I put them in. So I was doing them this morning. You know, anytime I get an alert, I just go to my computer or my phone. I can pop out those alerts. But yeah, they're real time. And I've been monitoring, as you can see, oops, through all these. I got a lot of stuff open, a lot of different trades. So these are just the September trades we're monitoring, and got the October ones I'm working on now. So anyway, I got to run. So I want to thank everybody for being here for the Coach's Corner. If you got more questions, let us know. You can always reach us at support@wealthbuildershq.com. There we go. And yeah, so I will see you again soon, hopefully. If you got any questions, if you do quarterly subscriptions to any of the programs, there's a 2-week free trial for it too, if you want to check it out. So yeah, happy trading, everybody. Talk to you soon.